Hi there, welcome to another tutorial of My Property app. Today we're going to be looking at how you can analyze a buy-to-let deal. So first of all, you need to log in, and once you're logged in, you will be here at the home page. Then what you can do is you can either go and watch a video, go to the dashboard, analyze deal or area analysis. If you want to analyze a buy-to-let, you click on analyze a deal. You'll have three options here: analyze a flip, buy-to-let or multi-let. Let's go and analyze a buy-to-let. On the top left hand corner you can say add new deal. What I like to do just for the user experience is I like to click this expand/compress, which just increases the size of the deal so that you can see more of the detail. Here you can upload a property photo of the property, so there we go, and we'll update. Here you can put the description, the address, all the details, which will then update the Google Maps on top. On the general information tab here, and as you'll remember, when analyzing a deal you need to go through these 7 stages. So the My Property app breaks down each stage to ensure that it's easy to understand and that it flows. The first one that we start with is area analysis, and right on the top you put some general information. So here we're looking at things like number of bedrooms, bathrooms. So you might put here it's a buy-to-let, it's a 4-bedroom, 3 bath house, 2 living rooms, 2 carports, 0 garages, 450 square meters, 450 square meters. Now the asking price is the price the seller has listed the property at. So let's say the property is listed at R1 million. That's what the owner wants for the property. The offer price is what we're going to offer the person. Now remember, in looking at investment properties, in property investing, you need to make money when you buy. Therefore you have to buy at a discount. Now I usually suggest to my students and to the users that you go for about a 20% discount. So I'm going to put here 800,000, which means the discount to asking price is 20%. Once I've finished running the numbers, I'll see what my return is, and if the return is too low, then I'll need to come and reduce my offer price. Okay, so that's the starting point. Then you've got the monthly rental income comparable. Here is where we're determining what could the rent of this property be. So perhaps you speak to a letting agent and they say that you could probably rent this out to a family for 12,000 Rand. And perhaps you need to go and consult with another estate agent, or maybe you're going to use a tool like TPN, and you go and ask TPN, and TPN says actually you can get 13,500 in an area like that for a 4-bedroom. And then perhaps you also want to go and speak to one more person, or you want to go and do a listing on Gumtree or Lightstone, or maybe you go and look at Property 24 and you see properties in that area are going for 11,500. So here you've gotten 3 sources, 3 independent sources, and all that the app has done is it's averaged the number for you. So it's taken those 3 rentals, 12, 13,500 and 11,500, and created an average for you, meaning that this is probably or likely the rent that you could achieve or expect in that area. Then we go to buying costs. Buying costs are all costs associated to buying the property. Again, we've put these tooltips here so that you can get a bit of learning as you go through the program. If you'd like to use a tool to be able to determine what your costs would be, then you can click on the button. It'll take you to the Uber website. Here you can put your purchase price of 800,000 and also the loan amount. So let's say that you're going to get a 90% loan from the bank. So then you're going to have to pay 720,000 Rand through a loan. So that's going to be the loan amount. And this is the purchase amount. Right? Nature of status. Is it a freehold, i.e. a freestanding property, or is it in a estate, a sectional title? Say sectional title. Is the seller registered for VAT? Usually no, unless you're buying from a business. So the answer is most likely no. And then are you buying it as a natural person in a company, a CC or a trust? Let's say a company. Calculate. Then on the right hand side here, it tells you what your bond registration costs are. It also tells you what your transfer costs are. So you can then take that information and apply it to the app. So bond registration, I'm going to summarize it as 25,000 Rand. And the transfer costs are 18,800, so I'll make it 19,000 Rand. Okay, there are a couple of other buying costs, things like if you needed to move the tenant, furnish the property, if there were some outstanding debts that you and the owner agreed would be on your bill as opposed to his bill. So there are some other buying costs that might be applicable. This is the section where you're going to put all of that information. Next, you've got the refurb costs. So we've given you 2 options here. We've given you a long list and a short list. The long list gives you all the different items from an exterior and interior point of view, things like the boundary wall, the gate and motor, painting, landscaping, structural, kitchen, bathroom, tiling. Anything and everything that we've seen in a basic renovation is included here. So you can choose to do the long list if you so choose, or you can go to the short list, which is a one input field that allows you to put in a total. So for example, maybe you're just going to put some costs behind modernization on the interior, and you're going to put, I don't know, 35,000 Rand into modernizing the property. There's also a section at the bottom here for any professional fees, labor costs, or contingencies. So for me, I always like to put a 10 to 15% contingency factor. All that does is it adds 10% on top of this in case the builder runs over time or over budget. All right, that's the refurb cost. Then you've got the other costs. So other costs are costs that are not necessarily applicable to all deals, but they're more like unique costs, things like evictions, zoning, holding costs, etc. Finance costs. This is where you're either going to get a loan from the bank or an investor. So here you might say you're going to get a 90% loan. So the bond you're going to loan, you're going to loan 720 from the bank. The deposit is what you need to put down, which is 80,000. Okay, the bond interest rate, the bond term, and here that is your bond repayment on a monthly basis. You might also want to approach an investor, let's call him Safiso, and you're going to loan 35,000. You're going to loan the renovation costs from him at a 10% over 5 years. Now you can choose to pay monthly interest and capital, monthly interest or end interest capital, which will affect your cash flow. Because if you're paying monthly interest and capital, you'll pay 743. If you're paying monthly interest only, you're going to pay 291. And if you're paying end interest and capital, meaning at the end of 5 years you're going to pay him his capital and his interest amount, it means on a monthly basis you're not paying anything. So let's say that you've agreed a monthly interest scenario with the investor. Second, the sixth step is cash flow. So here you can see your rental income, your finance cost, and then here on the left hand side are all the different expenses that are associated to property. So let's say that there is a 500 Rand levy, 250 Rand rates and taxes, the insurance of the building is 200. The void cost, very important. This tells you the cost of the property being empty. Now, when you're looking at rentals, your property is very likely going to be empty at least once in a year. So if your property is empty, you're not going to be getting rental. So for a usual buy-to-let, I would recommend anywhere between a 4 and 10% vacancy period. So here, for example, if you have a 10% vacancy period, it means you're going to lose 1,200 Rand per month. Because remember, there's going to be 10% of the time the property will be empty, so you need to put this money aside for those months that are empty. You might want to put a 5% contingency for voids. That is the kind of information that you can source from a tool called TPN. Management fee is the fee you're going to pay your managing agent, so somebody to manage the property for you. I'd recommend 8%, and then a management provision. So here, the geyser's going to burst, the paint needs to be redone, there's going to be things that break in the house. Make sure that you're putting 5% of your rental income away every single month for that provision for maintenance. And then maybe there's another 500 Rand fee for whatever. Right, the monthly cash flow, which is your income minus all your expenses in this deal, is 1,035 Rand. Now, is it a good deal? That's where step number 7 comes in. So step number 7 is your summary page. It tells you on the left-hand side what the numbers are, the asking price, offer, total costs, etc. Your gross yield, which is an important indicator, and then, of course, your projected ROI. Your projected return on investment is where you make your buying decision. So here, this deal is saying that on a monthly basis, your return will be 9.74%, which is okay. As you can see, it's an above average deal. It means it's doing better than it would in the bank. Your bank's money would maybe be working at 7 to 9%. This one is working at over 9%, so it's okay. But it's maybe not the best deal. This is where you could use the scenarios tab. The scenarios tab is telling you where the risk in your deal lies. As you can see here under rental income, what this is telling you is that if your rental income is as you expect, the original 12,333, you will get a 9.7% return. If your rental is 10% less than you expect, it'll be 0.3. If your rental is 10% more than you expect, then the return starts to become very positive. What you can see here is where the risk is. What I like about this part is also the revised purchase price. If your purchase price is 10% less, your return will become 22. So if we go to step 1 and we reduce our offer price by 10%, we make it 720, and we come to the end of the summary tab, an overview, our return will now be 17.6%. So that's how big a difference changing your purchase price would be. Right? Then what we can do is we can go to the rate of return. Now, what the rate of return is telling you is how your deal will do over a long period of time, over a 10, 20-year period of time. So in order to determine that, we need these 4 variables from you. Now, yearly expense increase, what this is saying is that every year things are getting more expensive, right? Usually things are getting more expensive by a rate of 6.5%. That is the rate of inflation. Rental increase, there's also oftentimes that your rent will go up by, between 6 and 9% per annum, depending on the area, depending on the demand. So maybe you want to say that the rent is going to go up by 8%. The discount rate is the rate at which money devalues. If you don't know what that means, just put 10% for there now. And then capital appreciation or depreciation. How much more valuable is your property becoming year on year? Let's say 5%. So calculate, the system will then go on the back end and basically project and predict what your deal will do over 20 years. So here what you can see is your return on investment over a long period of time. So it's just showing you what your returns would be over a 20-year period, as well as your income, expense, and cash flow. So what you can see here is that your income, expense, and cash flow is being plotted down. So you can see, is this a good deal today, or is this a good deal for 20 years to come? Especially with long-term properties like buy-to-lets, it's important to have that kind of information. And that, ladies and gentlemen, is how you would analyze a buy-to-let investment opportunity using My Property app. If you have any more questions or concerns, please go and check out our other tutorials, our frequently asked questions, or email us on support@mypropertyapp.online.